Welcome. Today, we're talking all about corporate bonds. We're going to break down exactly how they can be a really smart addition to your investment strategy and help you find that perfect sweet spot between risk and reward.
Okay, let's just dive right in. So many of us investors feel, well, stuck between two extremes when we're trying to build our portfolios. It almost feels like you have to make a choice, play it super safe, or go all in and take on a ton of risk. So, on one side, you've got the total safety of fixed deposits. You can think of them like a nice, calming glass of lemon water. It's stable, it's nourishing, you know exactly what you're going to get. But yeah, the returns are pretty low. And then on the other extreme, you've got stocks. They're like a can of Red Bull. All that high energy, high potential for amazing returns, but wow, they come with some serious risk and some stomach churning volatility. But what if there was something else? A middle path, An investment that could give you a shot at reasonable returns without keeping you up all night worrying about what the stock market is going to do. Well, that middle path can often be found with corporate bonds. They really do represent this fascinating and honestly often overlooked sweet spot for a lot of investors. So let's get into it and break down what they actually are. So what is a corporate bond, really? It's actually super simple. When you buy one, you are literally lending your money to a company. That's it. You're basically acting like the bank. And in exchange for that loan, the company promises to pay you regular interest. That's called a coupon. And then on a specific date in the future, they give you your original investment back. And this right here is probably the most important thing to get your head around. As a bondholder, you are a lender to the company. You're not an owner. That's what a stockholder is. Now, what does that mean for you? Well, it means your potential profit is fixed. But, and this is crucial, if that company gets into financial trouble, the lenders get paid back before the stockholders do. You're higher up in the pecking order.
Okay, so now that we know you're a lender, not an owner, why would you even do this? What's the case for making corporate bonds a real part of your portfolio?
And this chart just lays it out perfectly, right? Corporate bonds live right in that middle ground. They're designed to give you the chance at higher returns than you'd get from a fixed deposit, but without all the wild swings and high risk you see in the stock market.
So when you boil it all down, what are the big wins here? Well, you're looking at potentially higher returns, often somewhere in that 9 to 12% range. You get this predictable, steady stream of income from those interest payments. And because they don't always move in the same direction as the stock market, they are a fantastic tool for bringing some much-needed stability and diversification to your whole strategy. All right, but hold on. It can't all be perfect, can it? And you'd be right. While bonds are generally safer than stocks, they are absolutely not risk-free. It is so important to understand the potential villains you might run into here. I love this analogy. It's a great way to think about it. Not all companies that issue bonds are the same. Each one has its own unique character, its own Gabar style, if you will. Some are really trustworthy, but others can be way more dangerous for your money. You've got to know who you're dealing with.
So there are really three main villains you need to keep an eye on. First, there's credit risk. That's the chance the company just straight up fails to pay you back. Then you have market risk, where the value of your bond can actually go up or down as interest rates in the market change. And finally, liquidity risk. That's when you have trouble selling your bond quickly if you need your cash back before it's supposed to mature.
But out of all of those, there's one that's the absolute biggest fear, and that's credit risk. This is the big one. It's a risk that the company you loaned all that money to just goes bankrupt and can't pay you back. For a bond investment, that's pretty much game over.
Okay, here's a fun way to think about it, but it's super important. With dark chocolate, a 95% cocoa bar is really bitter, right? But it's considered healthy. In the bond world, you should think of those super high-risk, high-yield bonds like that 95% dark chocolate. Except in this case, that extreme bitterness is a sign of high risk that is definitely not good for your financial health. Okay, so we've talked about the scary stuff. Now for the good part. How do you actually pick a good bond? Let's walk through a really simple but powerful checklist. First things first, you absolutely have to become friends with credit ratings. A AAA rating means highest safety. The company is very likely to pay you back. As you go down the scale, the risk gets higher. Now, anything rated BBB or above is what's called investment grade. But once you get below that, you're in speculative territory, what people call junk bonds, where the risk of the company defaulting gets a whole lot higher. So to wrap all that up, here's your super simple 3-point checklist. Seriously, screenshot this.
First, check the YTM, the yield to maturity. That's the total return you'll get if you hold the bond all the way to the end. Second, check that credit rating we just talked about. Is this company safe enough for you? And third, check the tenure. How long is your money going to be locked in? You got to make sure that timeline actually fits with your own financial goal.
All right, so are you feeling like this might be for you? The good news is it's actually more accessible for regular investors like you and me than it has ever been before. Let's see how you can make it happen. And you know what? The best part is, getting started is way easier now than it's ever been. First, you'll need a demat account. Yep, the same kind you use for stocks. Then you can hop onto all sorts of online bond platforms and brokerage apps to browse what's out there, check the ratings, check the yields, and just invest. And you don't need a ton of money to start. Lots of bonds are now available with minimums that easily fit a retail budget.
So the big question is your portfolio ready to find that sweet spot? By carefully picking higher-rated bonds that really match what you're trying to achieve, you can add this powerful layer of stability and predictable income to your investments. You know, finding that balance between the safety of FDs and the growth of stocks, that could be the real key to building a more resilient financial future.